Hi, this is Kerry Artak with Wicked Stocks, bringing you an update in the TLT. That is the iShares 20-year Treasury Bond ETF, symbol TLT. I did record this video, by the way, on Monday morning, April 21, 2025. In case you're not familiar, the TLT is one of the more high volume, I actually think it is the highest volume ETF that is correlated with the long bond or the 20-year Treasury bond. This is a sort of a tranche of different Treasury instruments the ETF is comprised of. The average is more than 20 years, so it's relatively well correlated with the long bond, the 30-year U.S. Treasury bond contract, or market, I should say. This is a contract. This is the ETF. And so really, with respect to the TLT and bonds in general, when the price drops, it means interest rates are rising. And of course, the opposite is true. When the TLT rises, interest rates are dropping. And you can see this is a weekly chart. It's the same weekly chart I'll show throughout the entire video. And this goes back to the high that was put out. This is the all-time high for the TLT. In fact, I could condense this chart and show you going all the way back to the early 2000s. But I'm going to bring it back here. And this is the all-time high of 179.90 from March of 2020. This is the COVID low. This is the, basically the Fed attempting to save the economy from the disastrous effects of the shutdown, and so flooding the system with long bonds, reducing interest rates, and then rates began to climb, of course, especially during the supply chain bottlenecks, et cetera, during COVID, November of 21 to October of 22. This progressive rising at a rapid pace of interest rates did coincide, if you recall, with the bear market in stocks. The same exact sequence occurred over the course of 1 year, from roughly November 21, NASDAQ high, to October of 22, NASDAQ low. Since then, we've had these fluctuations. We've been kind of a two-sided framework, really, since this October 23 low of 82.74. But the takeaway from this image, and I've said it a few times, more than a few times, because I do update the TLT pretty frequently, especially lately with the wide fluctuations we've had in the interest rate markets, is that the 5-year trend, March of 2020, March of 2025, we're now in April, remains one of higher rates over the 5-year period of time. And that remains intact, that trend, at least by the measurement of a channel formation, a classic channel top at 93.83 this week, dropping weekly. We actually pushed into the 1% zone about 3 weeks ago when the stock market began to sell off on tariff talk. The initial reaction was a flight to quality, but as the stock market continued to drop, the bond market was flooded with, selling, and for various reasons. Some people say it was Asia dumping their securities, their treasury securities, in defiance of Donald Trump. Others just say that, the fact that we're going into a tariff war is a devaluing of all things America, including our bond market. But we do have a midterm support level. And by midterm, I'm talking, an 18-month channel bottom at 84.62, which we also tested inside the 1% zone. So this wedge is really, this is sort of the tipping point, really. We could fill this wedge out for the next month or two, but at some point, we're either going to A, close below 84.62, or B, above 93.83. If we closed above 93.83, that would mark, to some extent, a neutralizing of the longer-term trend in higher rates over the last 5 years. I'll get to that in a moment. And if we close below 84.62, it means more of the same. And typically, it is the longer-term structures that win the day, that win out. And so we have a 5-year bear market in the TLT, a 5-year trend of progressively higher rates in the long bond. And we've got a sort of a sideways framework for the most part. I mean, interspersed with, as the TLT rose, rates dropped, from October of 23 to December or so forth. I could go through the entire sequence. But if we close below 84.62, and I say that that is the likelier outcome by a degree, just because of the time frame of these two different trends, that should set off a follow-through selling. In other words, continued higher rates as we move through time. And let me just move through what the sequence I think would be. I will kind of cut to the chase with the third image. I'll get to the second or the fourth image. I'll get to the second and third, but this is really what I would expect as a big picture objective. You've got a violation of this very well structured channels formation. And if we close below 84.62 this week, that is the week of Monday, April 21st, we enter another sell signal. There's been a series of them. I could see one right here that occurred back, you've got it's kind of a double sell signal. Really, it closed below this channel and then ultimately below this channel. Little hesitation, then we continued south. That's just an example of what I'm talking about. And this would be sort of a similar sell signal that would exist within the confines of a long-term bear market. 66.71. I'm going to call this like a 2 to 3 month objective. It could be faster if there's sort of an alarm in the system, if it is, people running for the hills, so to speak, in the financial community, where they're just sort of dumping the long bond in quick succession. This could be rapid. This could be within a couple of months. But I really think, and here's an example of what I'm talking about, from August of 22 to October of 22. This is really kind of a 2 full months. And that's what I would see as a possibility. It could also be more of a meandering, the same sort of distance from March to October, where it could take 3 to 5 months, let's say. But either way you have it, closing below 84.62, I would expect 66.71. Full channel extension is a targeting mechanism. And with respect to the TLT, a 16.5% move in the TLT typically represents a 1 to 1.25% move in the long rate. And this drop would be around 21% in the low 20s. I'll let you do the math, but that would be about a 1.5 to 1.75% increase in longer-term interest rates over the course of 3 to 5 months or sooner. And that is really the takeaway here. Now, on the way down, it's worth noting that there are other formations that can slow this down. 81.12, and I'm presenting this mostly for you, swing traders. Right now, the swing trade, and I'll take us back to this image here. Right now, the swing trade is two-sided, where you're buying 84.62 and selling 93.83, and that could also be in the options markets with 85 strike puts, 93 strike calls, as an example. And so the framework is two-sided as we move really through the month of through the month of May. And if we do, though, close below 84.62, within 1 to 2 weeks, I would expect 81.12. I'm going to zoom in here in the post-editing. And we could trade inside of this kind of widening wedge for a number of weeks, 3 to 5 weeks perhaps, but the emphasis would still be 66.71. But I present 81.12 as just a tradable level for those of you who like to swing trade. Right now, it is a 1 to 2 month swing trade, 3 to 5 week swing trade between 84.62 and 93.83. If we close below 84.62, the 3 to 5 month emphasis becomes negative, expecting 66.71. But within a week or two, 81.12 can contain weekly lows, and they can battle it out for a few weeks before presumably the market would then close below 81.12 and result in a more accelerated descent to 66.71. And we also, it's worth noting, there is a long-term trend line here at 68.28 that will all converge in early June with 66.71. I imagine if we were to test this area by that point in time, this will be sort of inconsistent anyways. I'm just bringing it up. There will be other elements to look at. But it really is, this is the takeaway. Longer-term rates remain in an uptrend below 93.83, and that becomes more accelerated below 84.62 than anticipating 66.71. Inversely, if we close above 93.83, as I said, that is a bit of a neutralizing of a 5-year bear trend in the TLT itself, and I would expect within 1 to 3 months, depending on volatility, 102.91. And this is a formation that by that point in time could be the better part of 2 years in the making, can contain monthly, possibly quarterly highs, and we could trade inside of this area for a matter of months. It would be a settlement, and I've said this before, above 102.91. That is my alarm personally for recession. I think if we close above 102.91, we then have a complete turning of momentum, and the momentum should shift more to the upside for the TLT, continued lowering rates as we move through time. This could be, once again, the Fed taking action on an economic crisis of sorts. I think that is really all that needs to be said. I'm going to leave it at that for this week's TLT. You have a great week.